let's look back at business transactions, but now with that knowledge of debits and credits. We looked at business transactions first. We were just trying to figure out how they fit in with this accounting equation. But now that we have a grasp of debits and credits, we can do those same types of transactions with that knowledge. Okay? Because you're not going to find an accounting system that just says that one went up, one went down. You're going to find those rules of debits and credits are now how we record those business transactions. So let's look through the same examples that we looked through the first time so we can see how they're a little different with debit and credit. So before we looked at purchasing supplies for cash. That was the first thing that we did. Alright, so we've got two things that are affected. We've bought supplies, so our supplies account, and then we paid for them with cash. So we got supplies and cash. We talked about how both of those are assets. Okay, so early on, what I want you to do is go through this thought process. Alright, what accounts are they? Well, we've just said that we had supplies, so let's write that down. And we also had cash. So these are the two types of account. These are the two accounts. Now let's look at each one of them individually. What kind of an account is supplies? And we said before, this is an asset. And what kind of an account is cash? That is also an asset. Okay? So, supplies is an asset, and are we increasing or decreasing it? We purchase supplies for cash. So we've increased this asset. So if we increase an asset, do we debit it or credit it? Think back to those rules of accounting that we talked about. To increase an asset, we should debit. And I didn't mention this before. The abbreviation for debit is DR, and the abbreviation for credit is CR. Alright, so that's what that is, a DR. So we would debit the supplies account, and I think we used $50 before, so I'll use that again. Alright, so if we have cash as an asset, is it increasing or decreasing? We purchase supplies for cash, so we gave cash up, so it's going down. How do we decrease an asset? Well, we would credit the account. Again, it was for $50. Now, we talked about before, oh, that's horrible, hang on. We talked before how this would still keep the accounting equation in balance. They're all on the left side, but one went up and one went down by the same amount. So this is still in balance. But now that we know the debit-credit rules, how we actually record this business transaction is with something called a journal entry. We take this information and we journalize it. The process of taking business transaction data and recording it is called journalizing. And we actually journalize this in, surprisingly enough, the journal. We use what's called the general journal to record these everyday business transactions. So it looks kind of like what we've detailed out here. I'll draw a line. This is what we would actually record for this business transaction. Alright, we're going to put everything that gets debited, we list first, and then we indent and put everything that gets credited next. So we're going to write out supplies. And just like on your T account, debit is left and credit is right, you're going to put the debit in the left-hand column and the credit in a right-hand column. We call this a two-column journal, or two-column journal entry, same thing, but it goes in the journal, so that's why I refer to it that way. So, supplies, we're going to debit or put in the left for $50. Alright, our second account, we only have two. Now we're starting with the credits. So we're going to indent this just a little bit so we can easily tell what accounts are being credited. So we're going to have cash here, and we're crediting it, so we're going to put in the right column for $50. Now, the way we can easily tell if our accounting equation is in check is if all the debits equal all the credits. So, does the left column equal the right column, even if we had to add up some things? Yep, 50-50. My journal entry balances. I'm done with this one. Okay. Now, let's go over and do, excuse me. Let's look at the second example we did before, which is very similar. In fact, I'm going to just leave this. I'm going to erase what we've done. little bit. Erase the bottom part. The second example we gave before was that we purchased supplies on account. So we're still purchasing supplies. That didn't change. But what did change is that instead of paying for them, we now owe someone. We talked about before that that's a liability, and we called that accounts payable. We owe someone money. So we know that's a liability account. Can't get that P to work. Okay. And is it going up or is it going down? Do we owe someone more money? Do we owe them less if we paid off kind of a debt? No, we owe someone more. Okay, we purchased supplies. I have not yet paid for them. So we increase a liability with a what? With a credit. So we would credit that account for $50. All right, so again, we put all the debits first. Supplies, we debit in the left-hand column, $50. And we indent and write all of our credit accounts, which we only have one. Accounts payable, we put it in the credit right column, $50. There we go. Balance, journal entry is good. We have journalized. If this was the journal down here, then we would write it in and it would have been journalized. Now, let me give you a few other examples. Let me erase all this. So let's say that we have gotten the bill in for the electric company, or for our lights, okay? Our Georgia Power bill came in, for instance. But we're not paying it yet. We're going to enter it in the accounting system, but we're not paying it today. So we need to show a couple of things. What happens? We've gotten a bill in, but we're not paying it yet. Anything kind of jump to mind what one account might be? The first one that jumps to mind for me is that now I owe someone money. We've talked about that before. That would be accounts payable. All right, so let's talk about that one. Accounts payable, which is, we've already said, is a liability account. Okay. All right, and even let's even do it this way. Let's put it in reference to our accounting equation. So we'll come under liabilities. We've got accounts payable over here. It's a liability account. And if I owe someone now, that means it's going up. So to increase a liability, we do what? We credit it. All right, and let's say it was for, I don't know, $200. Okay. Well, great, but we haven't balanced our accounting equation yet, so we need to continue. Let's say now that, what's the other side? Well, we've used some electricity in the course of business. Well, we've used up a resource, or we've used something to produce our product or provide our service. Sounds like an expense account. And it would be. This would be an expense. And where does expense fall on this? Remember back to that tree that I talked about, what I refer to as the accounting equation tree. Where are the expense accounts? Well, they go into retained earnings, which is part of equity. So this is a type of equity. So we're going to call this utility expense. And this is an expense account, which is a type of equity. Okay? Now, here's where it gets a little tricky. Remember we talked about expenses. Okay, this expense account itself, though, is it going up or is it going down? You have gotten a bill, $200. That means that the expense itself is going up. So how do we increase an expense account? Well, we would debit it. And what do debits do to retained earnings? They decrease retained earnings. So that means that your equity account is actually decreasing. So the liability is increasing, equities are actually decreasing. But the expense account itself is actually going up. But it's because that expense account decreases equities. Okay? So we would debit it for $200. Alright, so now let's make our journal entry. Okay, remember debits go first, then credits. So we've got utility expense debited for $200. Then we've got accounts payable credited for $200. There we go. Alright, let's do one more with something that has more than two accounts in it. So now let's assume that you have purchased a piece of equipment, for instance, and the equipment cost you $50,000. All right, that's the sales price. You pay $10,000, and the rest of it you give them a note that you're going to pay over the next 5 years. All right. So what things are involved there? What types of accounts? Well, I mentioned equipment, so that's probably one that's going to be involved. Okay. And equipment is what kind of an account? Equipment is an asset. Okay. And then I said that we paid, and how much was the equipment? What did we say? It was $50,000. All right. And did the equipment go up or down? We bought it, we gave it away, or sold it. We bought it. All right, so that means that we're going to do what to equipment? Equipment is an asset. It's going up. We would debit it, if I could make a D. Okay. Now, I said we paid cash, so cash is probably involved. Cash is what kind of an account? It is an asset. Okay. How much cash did we pay, though? Did we pay all $50,000? No, we only paid $10,000 in cash. And was cash going up or going down? We paid it, so it's decreasing. And to decrease an asset, we would credit it. Well, we got two accounts, right? Are we done? Does our accounting equation balance? We increased assets by 50, we decreased them by 10. No, we do not balance, and our debits and our credits do not equal. We have $50,000 in debits. We only have $10,000 in credits. So we know something else is involved, and there was another piece of that too. I said we paid 10, and the rest we put on a note that would be paid over the next 5 years. Well, a note means that I owe someone money. So we have a note payable. Now, I shortcut that. You can write notes payable or note payable if you want to. N/P is just my shortcut way. The same with accounts payable. I do A/P or A/R for accounts receivable. You're welcome to do that in practice yourself. Notes payable. Okay, we owe someone. That sounds like a liability. Okay, if I owe someone, that means it's going up. I increase that account. I owe them more. And how much did I owe them? The equipment was $50,000. I paid 10, so now I owe 40. And to increase a liability, we would credit the account. All right, so let's make up our journal entry. Do all the debits first. So we've got equipment. We're debiting it, so it goes in the left, $50,000. All right, then all our credits we're going to indent. So we had cash up there. Put it in the right hand, the credit column, $10,000. And then we had notes payable, credited for $40,000. Now do we balance? Does the accounting equation balance? It does. And do the debits and the credits in the journal entry balance? Yes. So we are done with this. Now the next step would be, we have now journalized it. Okay, that journal entry is in the general journal. We'd have multiple journal entries in there. What happens next is we take those journal entries and we post them to something called the ledger. The ledger, imagine a big book, and on each page of the book would be a different account. So page 1 is cash, and page 2 is accounts receivable, and page 3 is, supplies, and you keep on going through. So they're organized in that financial statement order: your assets, your liabilities, then your equities. Okay, how we've listed them in that tree. It's how you'd find them in the ledger. So you would post from the journal to the ledger. So we'd take this and we'd go to the page where equipment is, and we'd debit that account for $50,000. And then we'd flip to the page where cash is, and we'd credit it or decrease it for $10,000. We'd flip to the notes payable page, and we'd put in there and put the $40,000 in the credit column there. And we could update each of those individual balances. Posting is not taking it to a T account, although a T account is, again, a visual representation of the account. So in simplistic form, we could use T accounts like that. But posting is simply taking it from the journal and posting it into the ledger. The ledger is where we have each individual account and all the activity we can see for each of those accounts. And again, you can use T accounts in a similar form to that. But that's what you mean by posting from the journal to the ledger. One thing a T account definitely is not is a journal entry. So if you're talking about journal entries, that's what we have at the bottom of the screen. A T account is one account. And even if you put an account for equipment and cash and notes payable, that is not a journal entry. This is a journal entry, okay? If you used a T account, that would be like posting. You'd post it from this journal to a ledger, which you would represent as T accounts, okay? You'll do a little bit of that in your homework, so you'll get some more exercise with this. But this takes you through how we use debits and credits and put it into a journal entry format.